So today's video is all about stocks, and we're going to be looking at smash day secrets. You see, when people are caught out on the wrong side of the trade, it leads to big market moves. And you make good money in markets when you can have a tiny risk, what I call lottery win style trades. So tiny risk, big winners. Doesn't happen very often, but when it does come in, it's like winning the lottery. It's like big winning trades, 10 to 1, 15 to 1, and so on. Now, let's really just dive right into this. Let's just zoom in a bit so that we can really see what's going on. Let's look from the beginning of 2023. Now, I'm on Apple. I'll start from the beginning of this upward trend. Okay. Now, in this upward trend here, it goes on for quite some time, about all of 2023 for the vast majority of it. That's up till August. Bit of a drop, and then off it goes again. Now, taking this upward trend here, we know predominantly we want to be buyers. And if you're looking for places where people are going to get proven wrong, is when they've sold and the market pushes to the upside. Okay, so I'm just using an 8 and 20 moving average here. Nothing fancy, a couple of moving averages for trend. And what I'm looking at specifically is when we have strong down closes in an upward trend. So let's just going to highlight a few of those right now so that you can see them. Strong down close in an upward trend. Here's some more. Strong down close in an upward trend. Strong down close in an upward trend. Strong down close in an overall upward trend. Strong down close, and again and again and again and again and again and again and again. All these at close in the bottom 20 to 25% of the candle. Here's another strong downward close, another one, some more through here. Now, here's the thing. When we have an upward trend and we have these strong down closes, everybody's selling, right? Everybody has sold throughout this and is essentially, if we zoom right in there, expecting the market to move down. Now, more often than not, that's going to happen. Okay, more often than not, you're going to get it wrong. But when you get it right, you get paid phenomenally well. Now, I've got to zoom really far into this so you can really understand it. But in this upward trend here, okay, to be fair, this one it hasn't quite crossed over yet. So we'll take this one here as the first one. 8's above 20, upward trend on Apple. This could be on Google, it could be on Microsoft, but it has to be on stocks, not Forex, not commodities, not crypto, stocks only. You can do it on stock indices, but it's purely a stocks trading system. Now, when we get these strong downward closes, everyone's thinking it's going to go down. So when the opposite happens, you get a big move in the opposing direction. So what we do, we'll use this. We buy at the close of the candle, and we put a stop loss just underneath the low of the candle. So we end up with a trade that has incredibly small risk. Now, there's no reward to risk on this. We don't put a target, okay? But we are going to have incredibly small risk on that, okay? So you could end up losing more than you intend. You want to trade this with much smaller risk than usual. But for argument's sake, let's say that we have bought this. The risk on it is 0.15 of a point. It's a very, very, very small amount of risk. And I'm just zooming right in so you can see what I'm doing is I'm buying on the close of this candle and putting a stop loss underneath the low of the day. Now you can see the next candle opens up underneath where your stop loss would have been. And of course you'd give it a tiny bit of a buffer. All right, but you're going to get stopped out and you're going to lose more than you intended. That's actually going to cost you, assuming we're risking 1% per trade, that's probably a 2% loss. Okay, that would be 1%. This distance here from where it opened would be another 1%. So you lost more than you intended, and that happens quite frequently. Okay, so that's a negative 2% there, assuming 1% risk. Next big down day over here, exactly the same trade setup. We're going to buy just before the market closes. We're going to put our stop loss underneath, and we're not going to have a target. Now this ends up opening all the way down here, so we end up losing 3 times what we intended. So far we've had one losing trade. So far we've had one losing trade, which was a -2, and a second losing trade, which is now -3. So we're -5 overall. We get the next trade. I don't think there's anything else up there. The next trade over here, again, we have tiny risk. And there's no reward to risk target, but tiny, tiny, tiny risk. You can see here that when it opened up in profit, it moved around and went down to the stop loss at some point. So we're now at -6. We've had 6 losing trades. Moving averages cross over and back again. Here's another one. So we've had -6 so far. Then we get this strong downward day. And the exit of the trade is to exit on the close of the next candle. So the close of the next candle is here. We end up making 1.25 back again. So not a lot. I'm going to call it 1 just for easy maths. So we were -6. We've had one winner. We're -5. Now that's not great. Okay, we get the next trade set up. Let's just add the next one. Here. Stop loss goes underneath. Target's irrelevant. It goes straight down, stops you out. So you're back at -6 again. This hasn't really closed down. Is it on the bottom 25% of the candle? Not really. It's a shame because it goes on to win, but it's not closed in the bottom 25% of the candle. Close in the bottom 25% of the candle, gaps up to here, it comes back down again, stops you out. So you're now at -7. Same thing happens here. It opens here. So your stop loss is underneath there. Now at -9. So you're thinking, oh my gosh, what's happening? Doesn't close in the bottom 25%, doesn't close in the bottom 25%, does close in the bottom 25%, opens up here and goes down, we lose. So we've lost like 10% now. And then you get this happen. We have a stop loss, and we exit on the close the following day. So that is a reward to risk ratio of 19.5. I'm going to just make sure that stops in the correct place. Sorry, 18. So we've gone from -10, we're now +18, we're +8 overall. And that's the kind of lottery ticket style trade that I'm talking about. So we carry on. This hasn't closed in the bottom 25%. This has closed in the bottom 25%, opens up and stops you out almost immediately, 1% loss. So you've gone from +8% to +7%. Doesn't close in the bottom 25%. This one does. So our risk on this trade is quarter of a point, and it ends up stopping us out for 1.65 points. So it's like 4, 5, 6, 7 points. We've got 7% loss there. So basically back at break even. Then we get this next one, big winning trade. So we have an entry, tiny stop loss, and a winning trade which makes us 15-1. So that's a 15-1 winner. So we've gone from 0 to +15. And you can see how it's actually gone even further than that. It's actually gone, 15-1 reward to risk. Fantastic. Okay, next big down day that closes in the bottom 25% of the candle is here. We end up losing, I think looking at that, it's about 4%. So we've got back at +11. This one loses, looks like a 2% loss. So from that perspective, we're now at +9. Here's our next trade. A risk. And then the exit on the close the following day gives us a reward to risk of 6-1. So we've gone from 9 + 6 to +15. Doesn't close low enough. Doesn't close low enough. This one does. Our risk, so we're at +15%. Our risk, and we exit on the close the following day, is a 5.75. So let's just call that a 5-1. Okay, so we're now at positive 20%. Here we get ourselves our next trade set up. I'll leave that one there. I'll just draw a new one. So we get our entry on the close, stop loss just underneath the low, exit on the close the following day. We get a 9-to-1 reward to risk, so we're now at 29%. Closes, I reckon let's just call it break even. It doesn't really make much money there. It's such a small amount, it's not worthwhile counting. So we're at 29%, doesn't close low enough. Next one. Closes, and look at this is like a textbook amazing. This makes your year, quite frankly, because you have such tiny risk. I mean, just with spread, it's going to have to be about there to cover spread and so on. But the reward to risk on that is insane. It ends up making it doubles your reward for the year. You go from 29% and it makes you 30%. So you're now at 59% for the year, and that's me rounding, giving it a bigger stop loss to make sure, because of spread. It's a huge winning trade. Okay, so it's anywhere from 30 to 40% there in terms of return. So let's just call it 60% for the year so far. That's me rounding down. Doesn't quite close low enough. Doesn't quite close low enough. Does close low enough and drops down several times. Looks like the distance between the close and the low, if we draw it on, is what? 0.4. And it loses 1.4. We'll call it a 3.5% loss. So you're back at 57, let's say. 57% now you've made for the year. Next big down day, losing trade. 56% for the year. Next big down day, up it jumps. Next down day, up it jumps. Next down day, up it jumps. You've just had 3 winning trades in a row at several percent for each one. Okay, now we're going to have bad days like this where it closes down. We might lose 10% on that particular day. But now we're in a downward trend, so we might be back at 50% for the year. Okay, let's even call it 45% for the year, because we had a bunch of losses. We had a bunch of wins through here, so you probably are at 50% for the year, even after that devastating loss. Okay, so you'd have risked this amount, risking 0.4, 0.5, and losing 5.6. You lost about 12% there. All right, but you were 60% up, or 57% up going into it, and you won probably 1.5, 1.5, and 2.5 prior to that. So even if we kind of ignore those and assume that they kind of cover all your brokerage and spread fees for the year, and just take that minus 12, you're still at 45% for the year so far. It's only August. But now on the way down in the downward trend, we're looking for strong up closes, and then we sell. So here's a strong upward close. We sell with a stop loss above the high. Okay, so let's just make sure we've got that flipped around. Just delete that and make sure it's a short position. We sell here with a tiny stop loss, and we get out of the trade here for a 7% return. So 45% becomes 52%. We sell, take a loss. We sell, take a loss. Wham. Here's your next one. We sell with a stop loss, and the reward there is almost 12 to 1. So what's that? 52%. Let's just call it 10. That'll cover a couple of losses there. We're back at 60% again for the year. Okay, and then we're looking, moving averages cross over. We're looking now for upward trend. Moving averages cross over. We're looking for strong buys to sell. Strong buy, sell. You'd have made probably 4 to 1 there. So you're at 60% for the year. Here's another one. That one probably didn't go high enough. Okay, but this one does. You'd have made some money out of this one. This is a small loser. If I just shrink it back out again. Here's a loser. You buy and get stopped out. Here's a winner. Downward trend, strong upward close, you sell, and you manage to exit the next day. So it's only a one-day trade. It's not like it's a huge length of time. You're not paying swap forever and ever and ever and ever. And your risk is so small, yet your return when you exit the following days, in this case, it's a 9 to 1. Well, that's definitely paid for any of those losses you had through there and then some. And now we're in an upward trend where we need strong downward closes. You don't get any strong downward closes through here, really, that are strong enough. Here's one, which would lose. And then here's one that just jumps massively up to there. We've got one setting up for today, potentially. So let's just make sure that says long position. So you took one loss through here somewhere, and then you took a risk, and then the exit, a 9% winner. All right, now, a lot of this is going to be down to the spread that you pay on the individual stock. So even if I've called Apple here a 60% return for the year, it's probably more than that, but let's just call it 60%. At the end of the day, you've probably only placed something like 15 trades, maybe 20. They've all exited very, very quickly. I mean, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. You're probably about 20, 24 trades. And you've made about 60% for the year. Never had to hold more than one night. Biggest drawdown was 10%, and you've made 60%. And that's just me looking at Apple. If we jump across and look at Microsoft, you're now going to have completely different trade opportunities. Okay, so just looking at these last, the run up to Christmas, October, November, December here, we've had, in this upward trend, strong downward close. So you're buying. Your risk is going to go underneath the candle low. And you end up getting out the next day up here for a 6.8 to 1 return. Your next trade sets up. You have the buy signal, your stop loss. You get out of the trade for a 5.6% return. You take a loser, that's fine. Take a second loser, that's fine. Next one sets up. You get a 2 to 1. Okay, we can live with that. Next one sets up. We get a, say, a 5 to 1 return. Okay, next one sets up over here. Tiny stop loss. And we get out of the trade for a profit the following day with a 21 to 1 return. There was another one just here a few days ago. Another one here which got stopped out. Another one here which made some money. So you're talking about having maybe a 30% success rate, but your reward to risk is like regularly 5, 6, 10, 15 to 1. And you're not setting a target here, you're just exiting the following day. All you need to see is an upward trend to buy downward closes, or in a downward trend, you buy upward closes. So in this downward trend through here, 8's underneath 20. All you're going to do is sell any strong upward closes. Well, it hasn't crossed over yet. Now it crosses over. Any strong upward closes, you're going to look to sell. So we have a strong upward close. We sell. The stop is going to be above the high of the day, which is tiny. And we get out of the trade at the close of the next day, which gives us a 38 to 1 reward. That's going to be more like 25 because of spread. But still, it's going to be insane. These don't close high enough. They aren't strong enough. Here's a nice strong upward close. Tiny, tiny risk. And we exit the trade for a 50, 60% return in a day. Now, it's probably more like 40 to 50 because of the charges and brokerage fees. It's going to be, there's got to count into that as well. But you can see the insane reward to risk that you get on these trades. So the point is, you've got to be trading this on stocks. It doesn't work on other markets. You need that hard open, hard close for it to work. And there's going to be periods where you go through drawdown, 10, 20% is normal. But when you're talking 60% plus per year in profit per symbol, per stock that you're trading, it's a phenomenal return on a trading system that really doesn't require anything than 2 wavy lines on a chart and checking if it closes in the bottom 25% of the candle. It's something that is an easy way to make extra money and works even better in a recession, which if we do go into, then it's going to give you phenomenal trading opportunities. So that's it for this video. Hopefully you enjoyed it. It's a very easy system that you should definitely build into your trading, as long as you're doing it only on stocks, only on daily charts. Big, liquid, Microsoft, Apple, etc. They're the ones you really want to be trading it on. And test for the last couple of years to see if it's profitable on different stocks, and then get stuck in and start trading it. It's not profitable on every single stock, but the vast majority it is, and do trade at smaller risk than you would do normally, because you are going to have a lot more losses than usual, and you have to take every single trade, because the last thing you want is to go loss and then miss the big 20-1 winner. If you enjoyed this video, leave a comment below. And I'm going to keep putting out new content like this to help you improve your trading every single day. And if you've got any questions, leave them in the comments below. I'll quite happily respond to them.